Welcome back, traders and investors. We have Ethan Premock on the line, and he works with Fari at Hamzei Analytics. He started out day trading and swing trading back in early 2007. He's still at it. He loves to trade the options markets. Ethan, how you doing today?
Very good. How about you?
We're doing okay. We just had a lot of fun with Fari, and we'll get into your high beta strangles in a second. But we just wanted to check. I've been thinking about you over the last since the last time you're on the show, and I know you were positioning yourself like me for decline. But I think the way that you do it, allows you to kind of wiggle in and wiggle out of your trades. And I know to be around as long as you have, you're not taking huge losses. So how have you handled this rally in August?
Well, let me first start by saying that the S&P's straight up move since August 8th and now back to all-time highs again actually has me even more concerned now than when you first interviewed me. The longer the market stays in this 2014 pattern of slowly grind higher on low volume without a natural correction, there is a higher chance that there will be a major market collapse or major bubble burst when the time comes. Now, I always get asked when it's going to happen, and my answer is always the same. It should have already happened. The S&P has had three chances to correct naturally in 2014 after gaining 45% from the announcement of QE3 6 weeks before re-election to the final trading day in 2013. Back in late January, early February this year, and back in April when Momo Tech stocks and the Russell were correcting, and just recently in early August. I now look at those three missed opportunities that the market could have corrected naturally as nothing more than people on the chase to not miss out on a little more market upside in an artificial low interest rate environment, just like when the chase was on at the end of the housing liar income loan artificial market as well. However, it's impossible to time the end. And in fact, a bubble usually, or the end of a bubble usually happens when everybody goes to bed one night thinking all is okay, and the next day it's over. So here's what I'm doing. During the last week of June, I was tweeting that I was targeting the ESE Mini 1972-1975 zone to exit all my swing long exposure in both SPY and also individual stocks. Once that target was achieved, I then started tweeting that I had zero interest in new swing longs. And from that point, my only longs will be day trades or within call put strangles while I'm building and adding to my long-term put positions. But when it comes to the adding, I don't do it blindly. All my ads are structured at very well mapped out levels before the market opens each day, which I base all daily targets using the a 10-minute and a hourly 24-hour charts. And when my targets are reached, I then use the sigma to confirm and execute the ad. The last time we spoke, I was scaling into October, December, and March 2015 puts. But after the V-shaped bounce since August 8th, I'm now also scaling into 2015, June 2015 puts as well. I still get the long exposure with the strangles, but at least I go to bed every night knowing that if the market keeps going up, the strangles will profit on the long side, or if I wake up to a market collapse, the strangles will have profit potential on the short side, along with my long-term SPY puts already being in place.
But what about? I mean, and I like strangles too, and I look at them and stuff. But man, a lot of times, and I'm just gonna throw it out an example here. I've been looking at a strangle in CMG here for a couple weeks. So if I would have put a strangle on in this thing, you're losing the juice. I mean, how you're losing that premium. So I know you don't know when it's going to end. How do you combat that that decay in the premium on both sides?
Okay,
If you're long the strangle,
okay.
if you're like a high beta strangle, you're paying a lot of juice for those, Ethan.
No, that's a good point. There's a trick to it. What I do is I look for a certain period, whether it's 2 days or 2 weeks, whatever the case may be. When I have the chart up, I'm looking for a certain scenario, and that is a scenario where I want to see whatever it is, even if I'm looking at Amazon, Twitter, Facebook, whatever, even Apple, whatever it is, Google. I wanted there to be several days of a very, very tight range. No action. It's basically dead money during that time. I'll start putting the puts and the calls that I want to use after I see that I want to possibly engage in a strangle with a particular name. Once I see that on my streamer, both the puts and the calls read on the day, that really gets me interested, because that means that less people are having interest in these puts and calls at the same time because the stock's not doing nothing. So what happens is when you engage at that point, this is very important, because you need to make sure that when the move does come, that the put and the call just doesn't offset each other. And when you buy the puts at the right time or the calls at the right time, where the premium is low on both, whichever move it is, the winning side surpasses what the losing side is losing. And that's the trick. That's the only way these can be profitable. But the next thing is you need to have not only the initial move, but you also have to be patient for the second leg, because the second leg is where it kicks in. And with the high beta names, you're actually hoping that one side just goes to zero. You don't even have to worry about the expired word list. And I've done it several times, especially with Tesla. We just closed 2 Twitter strangles out this week that were profitable. But the losing side went to zero, and we still had plenty of profit on the winning side to cover the entire cost on the losing side and still have profit well above that. But the trick is you got to make sure that you are buying these when the stock or whatever the index that you have interest in is almost dead money for several days or several weeks.
Okay, so you're buying the cheapies, and then so the one that you're losing on is minimal. Then if you get the big move in the other one, then that should more than offset the losses. Okay, that makes good sense. Just you do look at individual issues, right, as well as the indexes.
Yes, absolutely.
So what can you tell me about my CMG strangle here or a trade? I mean, a lot of times I think about putting on a strangle, and then my bear side takes over and I just buy the puts, and then a huge move takes place. What would you be looking at here? I don't know if you have any quotes on the options yet.
What's the exact symbol?
CMG. Chipotle Mexican Grill, who I ate there once and I didn't.
Okay,
Charlie, Mary, Grandpa.
Okay, give me 1 second.
Sure.
Charlie, Mary, Grandma.
Grandma,
Okay.
Grandpa. Yep. Look at that consolidation, gap up after earnings, and just look at that range here. I mean, it can't stay here, can it, forever?
No, I'm trying to look at a short term and a long term chart for
Okay.
you here. Oh yeah, this is perfect. That is the exact consolidation right there that you want to look at. I'm looking at the 4-hour, 180-day chart on it. Now it is close to the high, so you got to understand that you're going to need an explosive move to the upside for the calls to really benefit. Because without that, ideally you would rather have what you're seeing, that type of consolidation after rotation down. So you have plenty of upside potential and you have plenty of downside potential. So your upside could be limited here. So this one could be a little bit on the risky side on the call side. The move to the upside is going to have to be explosive. But ideally, that is exactly what you want to see to get into this type of strangle. But better if it was had a little rotation.
Okay.
For example, Twitter was like, after earnings, it traded sideways for 2-3 weeks, but it had the all-time high that it made after earnings that it had potential to go to. So there was plenty of upside, but it also had plenty of downside as well. This one, if the puts take over, oh my gosh, you'll do really good.
Okay, well you convinced me. I'm not going to put a strangle on. I'm just going to buy puts.
Okay.
I'm just joking with you. No, I'll keep an eye on it. Just looking at your other stuff with the high. Are you trading other option strategies besides your high beta strangles, or is that do you pretty?
There's actually 2 types of strangles that I do. One, like I just explained to you, where we use the same expiration, different strike prices, but same expiration where we want one side to go to zero and one side to be a winner. But I also do one where I would possibly consider with your Green Mountain Coffee here is I may have a short-term bullish bias like I had on Apple previous to yesterday going into the event. So I bought some very short-term calls, 30 days. They were like 30 days out. I bought I think it was the 102 calls 2 or 3 Mondays ago, and the calls obviously benefited. But what I did is I also bought an April 100 put, and I was targeting yesterday 103, 103.95 to 104 and a quarter zone to add to that put. So what I'm doing with that type of strangle is I'm actually averaging into the losing side, but I have a little protection while my short-term bias, my short-term bullish bias is winning. So I'm able to be aggressive on the ads because I have one side winning. So that's another strategy that I do, and I do these. I'm really doing these because at any moment we don't know how much more upside this market's going to have. It could be very limited at this point, especially as every time we get to the all-time highs, the energy's low, the volume's low. So that has me thinking the upside could be limited at this point. But we don't know when it's going to end. So I have these strangles and these strategies in place. So if we come to a market collapse one day, the puts take over. But if we keep going up, the calls are winning while we keep going up.
Okay, a question here from Rob Hood, and he's still looking at this. The move that we had in August here is just perhaps a correction. His question is: do you believe this possible correction will be the end of the bull market, or an opportunity to look for setups to the long side?
Any long side that I am doing is on a very, very short-term bias. The move from August 8th is basically a full V-shape out and then some. And the energy is just dying out up here. So I cannot see anybody getting aggressively long. A 4% pullback or 4%, what everybody calls now is the new correction, is not enough for me to be attracted or want to aggressively get heavy long. So nothing's attracted to me right now. So at this point, I would just be looking for long opportunities on a very short-term basis. And if you can, hold some of your longs and put some positions in place with some longer-term puts for when a real correction happens. We still have not had anything meaningful in over 3 years. And the volume up here in the low energy, every time we're at all-time highs in 2014, continues to have me thinking that less people have interest up here as the market gets expensive, which is normal. As things get expensive, less people have interest. So I just can't see what people are wanting or how much more they can think after being up 52% since the announcement of QE3 from the high that was made yesterday. How much more percentage is it worth having so much risk on at these levels? I just don't see it. So that's my thoughts.
Okay, and then yesterday, I'm sure you saw some of that action in some of the momentum stocks. Is that something? Some big reversals yesterday. Is that something when they start to exit the leaders? Is that something that kind of reinforces your thesis?
Yes, actually, what I've been noticing is when the index futures are down big or somewhat down in the pre-market session or overnight session, and as the pre-market opens for stocks in at 8 a.m. New York time, if the stocks don't move, the momos and the high beta stocks and the key stocks, if they don't move when the futures are down, it's most likely just going to be the usual buy as soon as the bell rings and goes back up. So yes, I am looking for the indexes and the key names, the high beta names, the leaders to be in sync, both pre-market and also during the regular trading session. And then once you would see, a scenario like that where everything's in sync, financials are going down, tech's going down, indexes are going down, you're going to see a better chance of some high energy selling and more of a confirmation that some sort of major pullback could be starting.
Okay, I just want to get your opinion on one more individual issue here. Goldman Sachs, I wrote an article on that yesterday, and boy, it has had a nice rally. Has moved up. The symbol is GS. Actually getting back to levels. I mean, you have to go to a monthly chart to find out the last time the stock was trading back over 180s. You had a little blip there earlier in the year, but you're now back above 180. This has been a zone that Goldman Sachs has struggled with going back since 2010 here. Now, is this, and I have a monthly chart up here. Um, is this something that, perhaps a strangle strategy would come into play? You've had a nice rally up, playing a potential breakout here and a run to 200, or a failure and perhaps back down to the 160 level?
No, I would not be looking at a strangle on this one for two reasons. One, it hasn't had enough consolidation. After rotation, it's been pretty much a straight up line since late July. So I have no interest in a strangle.
Okay.
But also the second reason is financials, and including GS, which I consider GS medium beta stock that when the market moves, it has a lot of potential to make money, whichever way it moves. But with the market in such low energy during regular trade sessions, I haven't been seeing the options moving much. So I've actually stayed away from Goldman Sachs. Normally I like trading in the right environment where there's better energy, but right now I'm completely staying away from Goldman Sachs. And after pulling up the chart just now, and to answer your question about the strangle, no interest in a strangle the way the chart's looking right now.
Okay, Ethan, I think I'm getting a handle on your strategies here, and just from looking at the charts, and I think it's something that could perhaps help me improve on my own trading instead of trying to be so one directional. Wait for these kind of setups with the strangles, and then don't be disappointed. If the stock makes a big move and I'm not in. Kind of what your strategies are talking about. Nick Shaheen kind of pinpoints and things like this. So I really appreciate you coming on, giving us your insight, your hard work, and any final tip for investors.
Not really. Just don't don't think that there's going to be a ton more upside, and don't use what are basically the Fed has been teaching people to stay away from risk management. Best advice I can give right now is don't listen to that. Stick to risk management. Don't worry about what the Fed's doing. Don't worry that we're going to stay in a low interest rate market forever. Don't worry that we can go up another 3, 4, 5%. Scale your profits. Don't be rushed into getting in the market just because CNBC says. Just use your own thoughts and your own discipline, and you'll come out. The profits will come. Don't worry about missing up on a little bit more upside.
Okay. Do you trade at the same office with Fari?
No, not at all. No, he's in Chicago. I'm in South Florida.
Oh, okay. I thought we could get a Fari straight. But, okay, Ethan, thanks a lot. Have a good trading day. We hope to have you on again soon.
Okay, thank you so much.